Good afternoon and welcome to the Summer 2025 Linneman Associates Capital Markets webinar presented by Linneman Associates and Real Estate Financial Modeling. This is your host, Bruce Kirsch, founder and CEO of REFM, provider of training and certifications to commercial real estate since 2009. We're pleased to have an insightful program for you all today, which will be presented by Dr. Peter Linneman, founder of Linneman Associates, which, for those of you who do not know, is a strategic and investment analysis advisory firm. We're using Zoom and we'll just go over some housekeeping items on the audio front. All of your audio is muted, meaning we cannot hear you as a participant. That's by design and will remain the case throughout the entire webinar. If you're attending by computer, take a moment to familiarize or reacquaint yourself with the control panel elements. We're going to be showing the slides, but if you would like to download them, we are sending them through in the chat now, and I'll send them through again in a few minutes. You don't need to have the slides up because we're going to be showing them in the viewer window, but they're yours for future reference. We've reserved 15 to 20 minutes at the end to answer your questions, but feel free to submit questions at any time during the presentation. Click on the Q&A button and type your question and make sure you click the button to send it through. If you get disconnected, just reconnect the same way that you connected originally. And if you're registered, later today you will receive an email with a link to the recording and the slides. And the video will also be posted on the Linneman Associates website later today. And without any further ado, I'll introduce the presenter, Dr. Peter Linneman, CEO of Linneman Associates. Peter, I can't believe that summer's just flown by already.
Yeah, it flew by. I had a very productive August in Kenya with the Sam Elimu charity, as well as with some family seeing animals, and went to Rwanda and saw the gorillas, which was arduous but impressive. So back to the groove the last 2 weeks. So thank you everyone for being here. I hope it's as lovely a weather there as it is here in Philadelphia. Go to the first slide, and I think it raises the issues we're going to try to talk about, which is there seems to be a lot of uncertainty, whether it's over tariffs and their impacts and what are they going to be, whether it's over deregulation in lots of areas and shrinking the government. I think some people, I might comment, some people like me have been in favor of shrinking the government for a long time. And there was an election that at least one of the platforms arguably was shrinking government, and yet people are shocked that they're actually trying to shrink the government footprint. It kind of is obvious. You can argue, are they doing it in the right way? But they are trying to shrink it. The Fed, what are they going to do, including this month? They sat on their hands in July and in August. Then the next day, very disappointing employment news came out, and they don't meet in August. So now they meet late September. What are they going to do, and does it matter? What about inflation? Is it over? What about lenders? Are they coming back? Are we going to have a recession this year or next year? And what about all these geopolitical issues around the world, not the least of which was a very overt display yesterday by China and North Korea and Russia of a sense of unity. But let's start out the next slide, kind of a quick economic status report. Sentiment is adjusting to reality. You may remember last time we talked, sentiment was quite dour, but the economic data was pretty good. And I had said, well, sentiment adjusts to reality, which is normally the case, and it has. Sentiment is rebounded a bit and is more in line with the economic data than it was from about March through about June. It has gotten more in line with reality. The economy is largely caught up in almost all ways, not in every way, with the shutdown that occurred 5 years ago. The Fed is keeping rates too high. It has very little impact on perhaps 80% of the economy, but it has a very dramatic effect on about 20% of the economy. And that 20% is slowed by needlessly high interest rates. That largely revolves around development, it revolves around housing, revolves around auto and other manufacturing. I don't think we are about to have a recession. We're in about the early part of a fourth, fifth year of recovery, and recoveries usually last 6 to 8 years. Given the depth we came out of, this recovery still has a lot of legs, particularly when you look at the auto sector and the housing sector, which have a lot of pent-up potential still. And it's important to note, and I point this out to people, that while the quote economy in an aggregate level is more than recovered from the shutdown, and we've largely gotten back on trend, about 20% of all metropolitan areas still have employment below 2019. So 1 out of 5 metropolitan areas still have employment lower than pre-pandemic, and 12 states, so roughly a quarter of all the states, have GDP, real GDP, lower than it was in 2019. So if you're in Texas, Florida, the Carolinas, Georgia, Utah, Arizona, Nevada, it's been go, go, go growth. But that's not everywhere in the country, and I think it's important to bear that in mind. Go to the next chart. What has the new administration meant to date? Interestingly, I didn't put it on the chart. We're all getting a legal education every day. I mean, every day is a new court ruling or a new discussion about what a court ruling will be on one dimension or another of the administration's efforts. Um, if you look at what's happened in the regulatory front, it's what they said. The regulatory footprint is shrinking. It's shrinking fast. It's still there, but it's shrinking fast. It's going to be more in line what it was during the Trump first administration, which was notably less than it was during Obama and Biden. And you see here the numbers I have based on pages in the Federal Register and estimates. They're not my estimates, they're estimates done of the cost of major regulatory actions during those administrations. There was a lot of discussion about the big beautiful bill. The big beautiful bill was most interesting in that it didn't change the tax law very much versus what it had been for 7 years. It only changed it relative to, if it hadn't been enacted, it would have reverted to what it was 8 years ago. So taxes have not really been lowered, it's that they didn't go up, and that's a good thing. Spending hasn't changed that much. The last several administrations and Congress have decided spending is quite enjoyable, mostly for political purposes. The political purposes are different of one administration than another, but spending has gone on. And again, you may like or dislike what they're spending on, but all these administrations and Congresses are spending. They like it. You knew that deficits would continue. There's no surprise there. Um, and they are going to continue. I get what I view a stupid question from time to time, which is, well, can we afford these deficits to continue? And the answer is, we certainly can afford them to continue the rest of my life and probably the rest of the life of your children. And you say, how? And I'll give a simple analogy, which is that in 1951, when I'm born, the United States was nowhere near as rich as it is now, was nowhere near as high income as it is now. It had just gone through the Great Depression and World War II and was struggling to come out. Very little wealth had been accumulated, very little income. You fast forward 74 years, and we've had a lot of years of wealth accumulation. We've had a lot of years of income growth, and we're massively richer. We're an incredibly rich country. And if you're incredibly rich, you could afford to outspend your income for a long time. And so, for example, could Jeff Bezos outspend his income by $1 billion a year? Sure. Could he do that forever? Well, based on the data, he could do it for maybe 200 years. He could do it essentially for the length that the nation has existed. And that's kind of the US today. We're really rich. And if we choose to borrow from the future to spend today, income is still growing, will continue to grow. People will be richer in the future. All we're doing is making them less rich than they would have otherwise been if we had not borrowed from the future. But they're still going to be rich. We have about $165 trillion in household wealth right now, which means we could spend $1 trillion more than our income for 165 years before we'd eat up household wealth. And it's even longer than that because household wealth would still be growing over that time period. So I'm not saying the spending is good. I'm just saying it can be. We are rich enough that we can afford it. The tariffs are floating around. Who knows what they are or what they'll be? My guess is they're going to end up in the range of 5 to 8% of imported value on average will be a tariff. That's higher than the current 3%. That will have a detrimental effect on the economy. Any tax slows the economy by weakening incentives. Are there some benefits? Of course. Is it a net negative? Yes. Probably the biggest burden of the tariffs to date has been uncertainty. If you go to the next chart, page 5, the border has tightened. And one of the things is, I think it's very hard for most people who believe in a nation and laws to be in favor of illegal immigration. And we had it running, I'm rounding at about 2 million a year through basically the Obama Trump years. It went to about 3.5 million during the first 3 years of Biden. That created an inordinate pushback. And at the current level, we're running essentially no illegal immigrants coming into the country. If you think about 3 years, we had 1.5 million beyond what we had normally absorbed that way. So you can imagine we have 4.5 million and beyond what trend would have been. So if for 2025 and 2026, we have very low levels of illegal immigration, it'll put us back onto trend, which would allow us to move back to some more number like 2 million a year, which is a lot to handle, but it does. It doesn't strain labor forces as much as people think. There's been a fair amount of research on this. There's a demand effect that illegal immigrants boost the economy. There's a supply effect. They more or less neutralize But there will be a modestly tightened low skill labor market. And as I said, there would be high profile deportations. They'll continue. Deficits, they're going to end up being very similar to the first 3 years of Trump. They won't be like the COVID years of Biden or Trump, but they'll be more in line with the first 3 years of Trump than the non-COVID years of Biden. There is very little statistical relationship between deficits and outstanding federal debt and interest rates. There's been a fair amount of research on that, and it doesn't really exist. And that's because of what I was saying. We have massive over collateralization of the federal debt, particularly when you realize that about 2/3 of federal debt is owned by US citizens and entities. So the debt burden is paid by citizens, but the 2/3 of what is paid flows to US citizens. The only leakage is the third that goes to foreigners. So the burden of the federal debt on the nation is not as large as it appears. And imagine if we owned all of our own debt. This is basically Japan. They own all of their own debt. So they pay a lot of interest on their debt. Their interest rates are lower, but they pay a lot of interest, but it all flows right back to Japanese. We're not quite in that situation, but we're not far off that situation. So it's not as onerous on the country as it might first appear in the headlines. Let's go to the charts. First is S&P. In a funny way, it's the ultimate sentiment index. Certainly in the short term. I don't think it's a sentiment index in the long term. Long term, it reflects underlying values, but in the short term, it's a good indicator of sentiments, only because in the short term, the long-term growth prospects haven't changed much. Therefore, most of the value change is reflecting optimism. S&P is basically rebounded, which is to say sentiment about the economy is largely rebounded. It's a very interesting market where most companies are not at record high valuations. There are some companies, particularly those around tech and AI, that have well above normal valuation multiples. And the way to think about it is there is a view among a certain base of investors that AI is creating a jump in productivity, not a trend continuation, but a jump. If they're right, and AI proves to be over the next decade a jump step in productivity increase, those stocks that currently appear to be highly valued will be undervalued as a group. If it turns out that it is just a continuation of trend of innovation, they'll turn out to be overvalued. And I don't think any of us know enough about what's going to happen with AI and true productivity to know which of those two scenarios is correct. But if you go to companies that are not in the AI space, you don't have aberrant valuations. Go to the next chart, federal deficit as a percent of GDP. You can see it's up. You see the COVID years were way up. It's running 4 to 5% of GDP. It's, in my view, needlessly high, but that's because we're needlessly spending. And you have to go through program by program to say what should be cut, because some government programs are highly productive, some are not. And as a group, I think we're not getting our money's worth. We continue to get less our money's worth. But there's a big political base for more spending. And then when you remember that, and based on 2023 data, 60% of tax filers paid no federal income tax, 60%. And that's an interesting political situation where a majority of the people pay no income tax, but they want to receive benefits. And that trend has grown and will probably continue to grow as a political reality here and elsewhere. Go to the next. I mentioned that the economy is largely recovered, real GDP. Um, the aqua line is trend from 2010s, which was not a big trend. 2010's trend in real GDP. The dark blue is actual. You can see we're way above the 27 trillion that we had at the beginning of the pandemic, but we're still slightly below trend, not wildly. That's largely because of auto and housing being slowed by needlessly high interest rates. Go to the next, you look at employment. Again, you see in the red where employment was pre-pandemic, the aqua is the trend, the blue is the actual. We still lag on employment. Well, if you think about it, if we lag on employment, but GDP is basically on trend, it says the gap is made up by growth and productivity. Namely, we're getting more out of the workers we've got. Um, if and so we still haven't caught up. In particular, older workers have not fully come back to the labor force. Other age categories pretty much have. If you go to the next slide, you'll see weekly unemployment insurance claims that come out every Thursday. As a percent of the labor force, we're quite low. We had the pandemic made it literally off the charts, where you were getting 4% of the labor force a week for several weeks becoming unemployed and collecting unemployment insurance. At one point, we had 22% of the economy collecting unemployment insurance just a little over 4 years ago. So people forget. The economy is kind of normalized. The labor market's reasonably strong. Go to the next is unemployment rates for everybody in the blue and for teens in the red. And they're both pretty solid. I like to show teens because they react bigger. And it's like a controlled experiment. You can see the actions and reactions sooner. They're both pretty stable and pretty low. Is it a perfect labor market? No, it's showing signs of slowing, by the way. We'll see what jobs report comes out tomorrow, very important. The last 2 months after revisions in the data, the last 2 months, we added about 75,000 jobs in the private sector each of the past 2 months. That big revision that you read about that happened to previous employment data was almost completely net in state and local government. I don't have an explanation as to why that's the case, that state and local government was so high, and I don't have an explanation as to why it was then revised down so dramatically. I don't think it's politics in the data, but there is a sense that the validity of all the data gets weaker and weaker all the time because none of us answer our phones anymore. None of us fill out surveys anymore. The survey response rates are going down, and therefore the accuracy of the data goes down and the volatility of the data goes up. Go to the next, the labor force participation rate of those 65 and older, still not fully back to where it was pre-pandemic. It's close, but it's still not fully back. And the trends have not resumed. The older workforce seems to say, I don't know that I need it. Go to the next. Another sign of normalization is the percent of industries adding workers. Kind of normalized. Coming out of the pandemic, everybody was adding workers. We're back down to probably 60% adding workers, which is a normal, solid economy. Go to the next. We've got an ongoing trend of people 65 and older, but the difference is as you come through time. If you go back to when this chart begins in 1960, the older population did not have income, they didn't have wealth, and they weren't very healthy. Today, they have wealth and they have income and they're largely healthy. And huge difference. And as that population grows, you want to follow where that money goes. Is it going to go to them, say on travel and leisure? Are they going to spend it on healthcare? Or are they going to spend it on their children and grandchildren? And the answer is they could do all of those. But it's important to understand how big that group is and that it will continue. Next chart, I just like to point out to people, my wife and I were picking up some food last night to carry out from a restaurant. Restaurant spending now way outstrips spending for groceries. When you realize that a good portion of grocery spending over the last 10 years is carry away, right? It's not the normal groceries. It's food to take home and eat that's been already prepared. And if you think of that as restaurant light, this would even be higher. So we graze a lot, and that's an important dimension of consumer spending. Go to the next, consumer confidence, about average, not particularly good, not particularly bad. The red line is average. It's about where it's at. And I think that kind of actually picks up where people's feelings are at. If you go to the next, small business optimism surged, really surged from being quite pessimistic to being very optimistic in November after the election. And then since then has come back to reality, namely politics continues, the world still got a lot of problems, and it's pretty average. It's up from where it had been during the Biden years, but it's pretty average overall. Go to the next chart is a reminder of one of the most lasting effects of the shutdown, COVID, all the policy reactions, et cetera, was that cheap mortgages allowed about 70% of US homeowners, which is about 42% of all households. They've locked in mortgages at 4% interest rates or less. That's a big disincentive to move. That's a big disincentive to sell. It doesn't mean no one moves and it doesn't mean no one sells. It just means fewer than normal. And if you look at the chart below, you can see a lot of them even have below 3% or below. So you have this as an impediment to liquidity. This is a lasting benefit for those who have it, for that 42% of households. But for those trying to get homes, it's an impediment, right? Because you not only have to pay for the house, you have to pay enough for the house to get them to want to sell their below market financing they've got locked in place. So part of the run up that you're seeing in housing is just a shortage of housing. But part of it is over the last few years, you also have to buy them out of their financing if you want their house. And that has boosted home prices. If you go to the next, we pointed this out, huge shortfall of single family units. It remains around 3.5 to 3.7 million, about a 3.5% shortfall. That's a huge driver of home prices. It's not going to go away in the near term. It's going to take a long time if it ever goes away. And it means home prices will continue to outstrip inflation as a general matter in the coming years. Go to the next, financial obligations of households as a percent of their disposable income. not so high. Yes, it's up from the bottom during 2020 when you had nothing you could spend money on. But in the historic context, the part I've circled the last 2 years, you would say it's low. Not that it's high. You would say it's up, but you would say it's still low historically. And that's partly because these 42% of households have locked in super low mortgage rates and other rates in some cases. Go to the next, retail activity. Retail activity conducted through brick or roughly conducted through brick continues to be 6 out of every $7 sold. It's still the dominant way retail takes place. This is excluding auto. You can see real have kind of flatlined at a new peak, but they've kind of flatlined over the last couple of years. If it's flatlined, what it means is basically retail sales are growing at the rate of inflation. So you're getting a nominal increase, but not much real throughput. Go to the next, the e-commerce as a percent of retail sales has flatlined since its surge during the pandemic. And what's happened there is it's just going back to trend. And it's just starting to resume trend kind of growth. It gets harder to grow online because there's less and less low-hanging fruit. Um, it's more and more difficult, and online retailers struggle to make profit on online retail. Online grocery sales, basically, you cannot make a profit on. Um, and it will continue to grow. It drives warehouse demand because things sold online take much more storage space, handling space than things sold through bricks. You go to the next, the Fed is completely misplayed monetary policy. They misplayed it during the 2010s. You see the blue line is the Fed funds rate. They kept it at zero for 8 years, even though the economy was growing. By the way, we had no consumer price inflation during that period. It's very interesting that for 8 years, the Fed kept the interest rate way too low at zero. There was no inflation, even though they kept the rate at zero. Now, why is that interesting? It's interesting because the Fed would say the reason they're not lowering rates today is that they're trying to stop inflation. Well, we had no inflation when we had zero rates. Why do you think there'll be a spurt of inflation if they reduce the rates from 4.5% to 4% or 3.5%? The Fed funds rate should be probably in the 2 to 2.5% range. The long-term treasury 10 years should probably be 3 to 3.5% instead of 4.2%. It's not there because the Fed continues to keep the short rate up. When they keep the short rate up, remember, since inflation peaked, the rate of inflation has fallen about 500 basis points, and they've only lowered the interest rate 100 basis points. That means the real return to being short is much higher than before they cut the interest rate. And that's keeping too much money in short, liquid, non-risk assets. That's the distortion. That's the problem of having the rate too high. Yes, it also discourages auto consumption and so forth, but the real burden is distortion of capital. The rate should come down, given where inflation is by at least 100 basis points. I think later this month, they're going to lower by 50 basis points. They misplayed it last August. They misplayed it this August. I still think we could get 100 basis points reduction in the Fed funds rate by the year end. Why? Because inflation's not the issue. They keep talking about it, but if you were an empirical person, you would look at the 8 years of zero short-term interest rate and no inflation and say, I don't get why you're so concerned about the interest rate coming down 25 or 50 basis points. If you go to the next, the Fed has always been late in my lifetime. Inflation is running for real. If you adjust for the problems in measurement in housing in particular, inflation's running 1.5% to 2%. The Fed says they're in no hurry, and then weeks later starts this very rapid rate increase. Last year, they said we see no need to cut further right before they cut 100 basis points over the last 5 months of the year. As I say, I think we're still getting it. There is a collapse of the, there's a collapse of the no cut in interest rates consensus on the Fed. I don't think the president's lobbying has a lot to do with the collapse of that. I think the collapse of that has to do with inflation has disappeared as supply chains adjusted. And if you go to the next, the Fed's index, this is an index created by the Fed of supply chain problems globally. When supply chain problems were large, like 4 standard deviations above normal shortages, globally of stuff, inflation surged. It was that simple. And it surged because we shut down the economy. A lot of capacity disappeared. Demand came back faster than supply. Prices went up. Then capacity came online. You can see this supply chain index said, oh, gee, we went from having too little supply to too much supply. And right now we're around normal, right around the zero line, which is normal. And that's why you're not getting much price inflation. Go to the next chart. I mentioned that CPI inflation, you can use other measures, but if you use CPI inflation without owner equivalent rent, no one pays owner equivalent rent. We've talked about it before. It is the only item in the CPI which no one actually pays for. No one. And yet it makes up about 25% of CPI. If you take that out, you can see we're running right about 2% inflation. That's not much different than what we've seen over the last 25 years. So inflation today without owner equivalent rent is basically the same as it's been for the last 25 years. There's no need for an abnormally high interest rate or abnormally restrictive monetary policy because inflation, net of one item which nobody buys, is normal. And if you go to the next chart, quick summary, year over year, it's been about 2.4% headline. Personal consumption expenditure inflation has been about 2.2%. But as you saw on the previous chart, you take out owner equivalent, you get a very different picture. And so, in fact, today's number is slightly lower than it had been. Go to the next chart. Banks' excess reserves are burning down. This is quantitative shrinking. They're burning down, but they're still above where they were in 2015 when QE 1, 2, and 3 ended. So we still have a lot of liquidity out in the system. Go to the next chart. The money supply is growing at about 4.5% a year. Not big. The money supply is actually smaller than it was a couple of years ago, slightly. So there's hardly excess liquidity in the market, even though the system has it. Go to the next. People still have a lot of cash. And the blue is cash holdings by the private sector. And they're going to use some of this money to travel, and they're going to use some of this money to buy cars. But when the short-term interest rate falls, they're also going to use some of this money to move out of cash into more illiquid and risky assets. And that would favor real estate when it occurs. Until that fall occurs, the return on just sitting in cash is too high and there's a lot of cash. Go to the next, crude oil prices, adjusted for inflation. The red line is the average since 1969, and we're basically at average since 1969. I don't see big spikes coming, even in light of vagaries in the Middle East. Guyana is a big producer. The US is the largest producer of oil and gas in the history of the world. Um, Thankfully, we had fracking, and as a result, we have a good degree of energy neutrality and efficiency. We have not made as big a mistakes as Europe has made in terms of green initiatives that try to accomplish in 5 years what should have been accomplished by market forces over the next 30 years. And they're paying a big price for doing that. Go to the next, it's government debt outstanding. The blue as a percent of GDP is headline. But if you take out the debt that the federal government owes itself, including owing the Fed, which is effectively part of the federal government, you come down to where it's not greater than 100% of GDP. It's more like 65% of GDP. That's not to say I say it's great. I just like facts to be facts. And then what I was talking about earlier, if you look at the debt held by foreigners, that's the only drainage of this debt. Every dollar of interest paid on federal debt that goes to some US recipient, either the US government as a recipient or private individuals as recipients, is just shuffling around the money. It's not changing the money. The money doesn't disappear. The US still has it. And if we paid off that debt, it would be paid off by US citizens and received by US citizens. It would be a net wash. Yes, it wouldn't be a wash for every individual, but it would be to the system. So there's a lot of federal debt outstanding, but not nearly as much as the Fright House kind of headlines. The real money we owe as a country, is what we owe to foreigners. And as a percent of our GDP, you can see that's trended down over the last 5 years. So that as a percent of our GDP, we actually owe less to foreigners than we did 5 years ago. And that money does drain out of our system. And then I'll do real quick, Bruce. I know we're running long, but the next, I'm going to take a real quick trip. Next chart is office vacancy. The worst appears to be over for office. Leasing activity has picked up. You've got more and more employers saying, come back to work. More and more employees are coming back to work. I do think we're in a continuing trend of working less and less. Remember, our grandfathers, great grandfathers worked 7 days a week, 6.5 days a week, then 6 days a week, then 5.5 days a week, then 5 days a week. And I think we're on trend to be working 4 days a week. And why? We get productivity growth continually over time, and crudely, we take about half of that productivity growth and get more income. And we take half of it and get more leisure. That is, we work less. And I think part of what you're seeing in the nobody works on Friday phenomena is just a continuation of We don't work 7 days, we don't work six, we don't work 5.5, we don't work five. It's just a continuation of us taking productivity growth and working fewer hours and enjoying that part of our life. Um, and I think that will continue. Go to the next, industrial vacancy rates, the real high quality stuff, lower vacancy, staying low, but vacancy rates have ticked up. It's still solid. It's not what it was 2.5 years ago, which was kind of the perfect era for industrial, but it's still doing pretty well. Retail vacancy is pretty rebounded. Um, Bad retail is empty, good retail is full. And I don't mean that in some definitional sense. If you've got a good shopping center with great demographics, great location, great ingress, egress, good other attendants, you're doing quite well. If you've got a center that's been cut off from consumers, has a bad grocer, et cetera, you're struggling. But in general, the market looks pretty good. Go to hotels, and occupancy rates still are not back up to where they were pre-pandemic. You're getting, especially this summer, a lot of international travelers, both European and Canadian, not coming because of headlines. I think they'll come back, but in the near term, they're not coming back. They're doing their own country or other places. So hotel occupancy, much improved, but still not back. And then go to multifamily. Multifamily is probably weathered the worst. It had an amazing period. Then it had too much supply come online. It's been a struggle the last 2 years. It's not been catastrophic like 2002 or 1990 through 1994, but it's been a struggle. The supply pipeline is drying up, and as that occurs, the sector gets healthier. And I think most markets are through the worst and go from there. Bruce, let me stop there and go to questions. But the bottom line is real estate doing okay, not as much capital as you'd like to see going because of the high short-term interest rates from the Fed, and the economy doing okay, though slowing, would be a summary.
Hey, great. Thank you very much, Peter. Well, we don't want to get your head too big, but a couple of folks have written in saying, how do we nominate Peter to be chair of the Federal Reserve Board?
I'm too smart.
Okay. Um, we have a lot of thoughts on interest rates, and one in particular question is, if the short rate comes down, do you expect that the long rate is also going to come down materially?
Yes, in the standard knock-on effect of rotation of assets, right? When imagine that you could get a 52% real rate of return on short-term money. Would there be much demand for government paper longer than short term? No. You'd have to bribe people to go out there, right? And that's what's happened. The return on the short end is too high, and that keeps the long rates up because you've got to bribe people to go out for that illiquidity, that duration. So as the short rate comes down, the long rate will come down by the natural rotation of assets. And we got an indication of this a year and a half ago when the Fed started cutting rates and the long rate got down to 3.6 and the 10-year got down to 3.6. And that's because people rotated out of the long excuse me, out of the short into long, which bid up the price of long, which bid down the yield on long. And then the Fed said, nope, nope, we're not going to cut rates. And you saw people going, okay, then I'm going to rotate back into short duration and out of
Right.
long duration, and you saw the long rate go up. So that's the dynamics that's driving it.
Thank you. I think a couple of webinars ago, you had a slide about where do you put your stay rich money right now and where do you put your get rich money? What's your stance on that as of this quarter?
Well, I think I was reasonably right in that at the time, that was what, probably 3 quarters ago, I said
Yeah.
my get rich money, I'd probably go into office, and I was in office um, through some REIT holdings and such. I think that's turned out to be a good get rich. There's been pretty good movement in the office sector, um, both public and private, since then. Now, you might say, yeah, but the prices are still down. Yeah, the prices are still down, but they're up considerably from their bottom probably a year ago. So I still think there's more room to run there on the office side on the get rich. I think the other on the get rich is hospitality at the moment. And that's because right now there's a lot of frustration that Canadians aren't coming, excuse me, and Europeans aren't coming. And there's this sense that they're going to hate America forever and they're never ever going to come here again. And I just don't believe that. And I think that markets that rely on Canadians and Europeans, hospitality, you could get a quite pleasant surprise. I think there's one other that it's hard to play, but the bulletproof universities that have very low acceptance rates, um, none of them grew a lot over the last 30 years. And they're all under financial pressure from Trump with this. They're under pressure with foreign students not coming. And so they're under financial pressures. And you read a lot about, well, I think one way to play those financial pressures are one of the oldest ways universities deal with financial pressures is increase enrollment. And the schools that have very low acceptance rates have a lot of room to do that. If you don't have many applicants, you don't have room to do that. And therefore, student-related housing around bulletproof universities that are under financial strain, but they can increase enrollment, they can
Right.
expand acceptance.
Right.
You could get a very pleasant surprise over the next 5 years in that there'll be a lot more students needing housing than you might expect as the knock on of that. The stay rich, I still like apartments, um, steady Eddie kind of stuff. I still like that.
So if we have basically normal inflation and the general expectation is that rates are likely to come down in the next 3 to 6 months, what stands in the way that we're not seeing that could potentially derail a full-blown recovery?
I just think this will sound stupid, but it's true. Something unforeseeable, right? Something unforeseeable. It won't be something foreseeable. I contrast that with in 2000, early 2007, late 2006, I wrote, I think we're going to see a recession in the next year or so. Not with precision in the next year or so, because there were a lot of excesses build up, and you could see the excesses build up. And And by the way, I was starting to write in 2018 and 19 that in 2021, I could see similar forces building, there'd be a recession. Now, what happened in 2021 was there was a 2020, there was a recession, but it wasn't from the foreseeable, right? It was from COVID and the knock-ons. I just don't think we're at a point in a cycle where foreseeable forces can create a recession. We're kind of where we were in 2015 or 16 or 17, which is the only thing that could have created a recession in 15, 16, 17, 18 would have been an unforeseeable phenomena, terrorist attack, I don't know, some horrible thing, horrible pandemic, whatever. I don't see it coming from a foreseeable force.
Thank you. How should we be thinking about the relationship between the 10-year and the US GDP growth rate?
There's an endless amounts of airy-fairy analysis done on this with very elegant mathematical models. Um, Basically, when it's all said and done, if the economy can keep growing at a kind of the rate it has grown in real terms over the last 30 years, 40 years, the long rate should be in the range, which by the way, is a 2 to 2.5 percentage point annual growth rate, real. The 10-year treasury should be 50 to 100 basis points over that. Um, and that's changed a little over time. It used to be higher than that before the fall of the Soviet Union, the growth of China, the growth of money in other places of the world that want to invest in the US. But 3 to 3.5% as the centering point, which means, let's just say 3.25 for a number. That's the centering point, which means sometimes it'll bounce up to 4% on volatility, and sometimes it'll bounce down to 2.6 on volatility, and then normalize around 3.25, some number like that.
Okay, one last one. What's your take on the impacts of tariffs? Has anything been accomplished?
Well,
Is there,
yes, it depends what you wanted accomplished. Certainly what's been accomplished.
has anything good been accomplished?
Well, I think probably, yes, something good has been accomplished in that it has sent a message that we are serious about improving terms of trade. All right. I think that message has been delivered loud and clear. And sometimes delivering a message is a good thing. If you say on a fundamental level, no, because it's just a tax, and taxes slow the economy. There's basically never been a tax created that hasn't slowed the economy, ever, of any type. And that's because it distorts incentive. It takes money away from what people would voluntarily do on their own and gives some of it to the government, and therefore distorts their incentives. So in that sense, it's not done good. I thought you were going to ask the most important question, Bruce, which is what about the Eagles tonight? uh, NFL opener, right? Philly,
Right.
they've been down drinking, I'm told, since 8:25 this morning. So my prediction is no matter whether the Eagles win or lose, there'll be a lot of drunk young people down there come 11 o'clock tonight.
I think that's a pretty fair assessment. Well,
Thank
thank
you,
you.
everybody.
Thank you again. Unfortunately, we're not going to be able to get to all of the questions, but I want to make sure everyone's aware this presentation is just a digest of what's given in a lot greater detail in the Linneman letter, which is a quarterly subscription from Linneman Associates, and more information can be found on that at the Linneman Associates website, linnemansociates.com. As one last reminder, if you registered, you will automatically receive an email link to the recording of the webinar in about an hour. Thank you again, everybody, for joining, and we will see you back next quarter. Thank you, Peter.
Bye bye all.